Now, we've got two very distinguished speakers here this afternoon to talk on this particular topic. We've got David Jones from Aberdeen Asset Management and Adam Laird from Hargreaves Lansdown. I'm now going to let them, while I shimmy over here as furtively as I possibly can, introduce themselves, tell you how wonderful they are, tell you how wonderful their firms are, and why you should be listening to them this afternoon. And then I've got a long list of questions because these guys covering a fascinating topic. But in the end, this is an education event for all of you. So I'd much rather that you were the ones asking the questions, finding out what interests you, so you don't have to listen to what interests me. So if you go shy on me, I do have a list of pre-prepared questions. The guys have even seen it, so how boring is that going to be? So it's much better off if you're out there asking some testing ones, because then you'll learn what's of greatest interest to you, hopefully. So we'll start off with David, and then I'll shimmy over here and try not to disturb him while he's speaking.
No problem, sir. Hi, I'm David Jones, a Senior Investment Manager at Aberdeen Asset Management. I've been managing passive funds since 1998 and have been at Aberdeen Asset Management since 2000, so a fair amount of experience in managing passive funds. And in essence, it's quite a simple concept. A passive fund targets the benchmark return. So I'd like to talk about a unique fund that we have at Aberdeen in the passive space, and that's the Aberdeen UK Tracker Trust. This is the only closed-ended investment fund that tracks an index and is listed on the London Stock Exchange. It has assets under management of around £330 million, and it tracks the FTSE All-Share Index. The All-Share Index covers around 98% by value of the premium listed companies on the London Stock Exchange. So as you can appreciate, that brings about its benefits of diversification. The FTSE All-Share Index is made up of the FTSE 100, the FTSE 250, and the FTSE Small Cap indices. So therefore, we've got large, mid, small cap companies across a whole range of sectors. I would say that that the small cap companies tend to be more domestically focused, and the large cap companies more international based. For example, Aberdeen Asset Management. We operate in 25 different countries around the world and earn revenue from all of those countries. So we're a true global business. So apart from the benefits of diversification, what else does Aberdeen UK Tracker Trust give investors? We've been going since 1990, so we've got a long track history and performance record of actually tracking the FTSE All-Share Index. And I think that's a fairly unique selling point. Because it's a closed-ended fund, an investment trust, we have an independent board of directors who ensure that Aberdeen, as managers, manage the fund in line with its investment objective. And they also make sure that the investment objective is still relevant to investors. Being the FTSE All-Share Index, there's not only the potential of capital appreciation, but income as well, which is quite key at the moment, given the way interest rates are on cash. The FTSE All-Share yields around 3.3% per annum currently, and the investment trust pays that out twice a year in the form of dividends. And what else can we say about the trust? This is a key point, I think, in passive investing. Costs drag performance, so therefore you really need to focus on what costs are involved in managing a passive fund. And the UK Tracker Trust last year had an ongoing charge of 0.3% of funds under management, and of that, around just under 50% encompassed the management fee. And a final point of uniqueness, I would say, about the Aberdeen UK Tracker Trust is the fact that it is closed-ended. Most other tracker vehicles are open-ended, which means they get cash flows into or out of the funds. This creates an awful lot of trading, potential trading, and trading creates cost. Cost drags on performance, and our investment process is simplified by being a closed-ended fund. I would also say that Aberdeen, since we acquired SWIP, we also have open-ended funds as well, tracking the all-share as well as other indices. Currently we have around 30 billion in passive strategies, and around the same again in other quant-based strategies at Aberdeen. So it's quite an exciting time to be in passive management at Aberdeen.
Adam.
So I'm Adam Laird. I'm from Hargreaves Lansdown. We're a stockbroker and an investment platform for private individuals. Based in Bristol, we look after around about £45 billion worth of investments on behalf of around 650,000 investors. My role is as passive investment manager, which means that I cover research, trading ideas and information on tracker funds, exchange traded funds, index tracking investment trust,
The one.
and other index-linked investments on behalf of investors. We are a whole-of-market broker, so we look at anything that's available for retail individuals. In order to help our investors make the right decisions, we have a list called the Core Tracker list, and these are currently 12 funds that we think represent the best quality and the best value for investors in passively managed investments. Currently, it covers funds from every major investment sector, where we have looked at the costs to make sure that they're good value for investors. We've looked at the index the fund tracks to make sure that it's a representative index of its market, that it's going to perform well in the future. And we've looked at how the fund actually manages the investments to ensure that what you buy, the results that you'll get, are what you would expect for an investment in that area.
So we've got experts covering all areas of passive investment, whether it's algo funds and investment trust, singular, exchange-traded products, or classic trackers. Again, I've got this list of softballs here, but I think it'd be much more fun if you guys were to ask a few questions. So once we've broken the ice, I'm sure there'll be loads of them, particularly about the investment trust. And there's a lady here. Thank you very much. And then a gentleman just there. If you could wait for the microphone, that would be great, because the acoustics in here, not everybody's got a big mouth like I have, so sometimes it can be quite hard to hear people. And then a gentleman just down there. Thank you.
Hi there, this is about the investment trust. Being an investment trust, then how do you manage the discount?
Okay, yeah. The underlying assets, the net asset value, is usually at a higher level than the share price, and that's known as the discount. And we have board authority to tighten the discount, i.e. buy back shares if the discount starts to widen. But what we'd rather do is to market to retail investors like yourselves to increase the demand for the shares in the trust. The demand for the shares creates an uplift in the pricing and closes the discount. So we do have
what the current discount is roughly.
It's sitting at around 5%.
Thank you.
It's been between 4 and 6% in that sort of corridor for the last 3 or 4 years. I actually see it as an opportunity, though. If you see the discount widening out, then that's a great buying opportunity. If you know that there's board authority to buy back shares to tighten the discount, then...
Sorry, could you just... Thank you.
Sorry, but just to clarify, so if the discount widened, would you would step in
it really depended on
put a bottom on it, would you?
Really would depend on market conditions.
Okay.
As in, yeah, if shares were falling and discounts were widening across every investment trust, then it would be foolish to go in and start buying our own shares. But if we see that just a small amount of buying tightens the discount up, then we go ahead. We have authority from the board to do that. So
okay, thanks.
It's monitored very closely, not just by myself, but by the board. We need to be on top of it.
Please.
Hello?
Yes.
Oh, good, thank you. What advice would you give to a young person starting up a pension? What kind of trackers would you suggest for a good starter to get someone going?
We see a lot of investors using tracker funds, especially in pension. I would just add that I think that because the charges are so low, and for young people who maybe have 30, 35 years before they intend to take their pension, the difference that you can make by keeping your management charges low will really make a big difference in the long term. For me, I would say that investors should look to split. Generally, the longer your investment horizon, then the more risk that you can afford to take. So I would make sure that my pension has a mix of a good proportion in equity tracker funds, and I would make sure that it's split both with UK and with global investments. So a balanced portfolio for a younger person with a long investment time frame might have even up to 80% in equities. And alongside that, you want often you'll have a little bit in fixed income in bonds. That just keeps the portfolio diversified over the long term. And if you can afford to take the risk, then investing in corporate bonds will produce, you would expect over the long run, better returns than government bonds. But there's a lot of very broad-based funds that are available out there, which will invest in global equities across the UK market, and which will be well poised to give you that good long-term return.
I would actually say as well, from that, we're talking about passive investing here, but this is where you can perhaps take a more active view by investing in a passive, in a region where you think there's more potential growth. So, for example, in an emerging market passive fund, if you're weighting that up, then although it's a passive fund, you're making an active decision to actually increase your weight in that area because you want to take a little bit more risk in that area. So it's not just pure passive, you're taking active decisions as well.
Gentleman in the white shirt there, please. Thank you.
Thank you. Well, coming back to the charges, I know you do sometimes fund of funds. Does that mean you're having two layers of charges and sometimes the bottom rung of your fund would have another fund underneath, so it could end up sort of like 3 layers of charges on the funds?
Well, on the investment trust, that wouldn't actually happen at all because we only invest in the constituents of the underlying index, so there wouldn't be fund-to-fund charges.
From the point of view of the account, overall, you have the tracker fund itself, or the investment, which will have its layer of management charges, which is perhaps what David's managing. You will also then typically find yourself with account management charges from the platform or from the company, like the stockbroker who's doing the administration on his behalf. And you're right, there are 2 levels of charges there. It's important to look at those together whenever you choose an investment, and to make sure that you're getting the best value for money on the investments and on the platform itself, because they both go together to make up the costs, which will affect the return that you will get over the long run on your investment.
Does that help? Perfect. Any more questions, please? Gentleman down, there's two at the front here, please. Thank you. Gentleman with glasses on his head, and then a gentleman at the front, please.
Just on this dual fees, shall we call them charges, because it's great that your charge is 0.3, love it to bits, as do I like Vanguard's charges, etc. But then when I flip onto a platform, should it be Hargreaves or etc., and I have a 0.4 uncapped charge, it's sort of on the compounding effect, it makes a hell of a difference. What's the panel's thought about these non-capped platform fees? Because it is off-putting, and if I was the fund, I would be putting it in places that don't have a capped charge.
You're right. There's different ways that you can look at the investment charges, and I think it's a question that everyone has to weigh up whenever they're choosing their investments. Different platforms like ourselves, we have a percentage fee, which, as you say, will go up with the amount of assets. For larger portfolios, it's a lower percentage. And there are other brokers who have fixed charges, and fee is capped and perhaps have additional charges for extras. Through a company like Hargreaves, our fee covers all the services that we offer. Whenever you have an account with us, you get access to our help desks, our research information, use of the tax wrappers like the ISA or SIP pension accounts. Different people will find different services more useful and less. It's a question for everyone, but certainly shop around, have a look at the brokers, and costs have come down a lot in the last few years. And make sure that you're getting a company which offers you the right services for you.
Yeah, definitely shop around. I mean, Aberdeen has its own ISA platform for investment trusts, and so you're already paying the fee for the investment trust. So the ISA platforms are pretty cheap.
Okay, I'm actually with Hargreaves, and the one bit that puts me off is this 0.4. You've got a cap on every other product offering, but you don't have a cap on your funds, which is off-putting, and I have to go elsewhere for that.
Of course, we have, and just to fill in, the charge that we have is for holding funds, for holding unit trust and open-ended funds. If you are investing something like the investment trust, like you run, or exchange-traded funds, our fees are actually capped. So again, it's about putting them together, seeing what you hold, seeing what the right investments, and then looking at the service overall.
Thank you. Question at the front here, please, and then the lady here and the gentleman there.
Could I ask what role you see for the more selective kind of tracker approaches, which seem to be increasing, high dividend and so on, selected out? As in,
you mean the underlying benchmarks? So you're on a yield-focused benchmark.
Yes, that sort of thing. What kind of role do you think that should play in a basically general, fairly passive long-term strategy?
It really depends on what your aims are in your investments. I mean, obviously, if you're going for a high yield product, throwing off the yield, then there's a particular reason why you want to do that, and that may be that the yield is for your retirement. You've just retired, and you need the income on a regular basis. So it really just depends on what you're actually investing for.
So these products that you're referring to sometimes are called smart beta investments. And this is something which is coming quite popular within the ETF, the exchange traded fund space. I think this is a really interesting part of the product landscape that we've got at the moment, because there's so much more innovation coming through and different ways that we can use passive investment rules to generate high dividends or low volatility. And I think that this meets a lot of investors' needs. There's a lot of people out there who want to take a higher income than the market and the hold for their investment. And these products are really filling that space. I think that they can be useful, but I think that investors need to make sure that you've had a look through, that you've really done your homework on them, because these products aren't all created the same, and some of them have their risks that are involved. Sometimes, you mentioned a high dividend, which is only one of these strategies, but sometimes these products have been, in the past, have been very concentrated in one market sector. For example, banks. And sometimes this is added to the risk at different points in the market. So, do I think these are a good product to use? Yes, in the right place, but make sure you understand them fully whenever you invest. That advice could go on any investment, but certainly here.
They're kind of a halfway house between passive and active. It's like an active index, if you like. So you're actually following, say, for example, a fundamental index where you're looking at things like price to book. You're looking at sales, and they're essentially just a way of following a different index rule, rather than pure market capitalisation. We're focusing on a different strategy, and hopefully with a low cost element involved, because you're basically following an index.
Thank you. A lady at the front here, please.
Thank you. Hello. My question is directed to Adam. I wish to know if I am a Hargreaves Lansdown customer. It's not specifically about what you're talking about, but it's going back to costs. Come April 2015 next year, when people can liquidate their pensions if they so wish, does Hargreaves Lansdown have any exit costs if one wanted to liquidate one SIP?
Slightly off piece, but do you want to take this one here, or?
Probably best if we have a chat about this afterwards.
Is that all right?
Because we are still looking.
It's not a fob off, I promise, and I work for a competitor, so I'm not protecting him. I'm quite happy to feed him to the wolves, I can assure you. Gentleman here, and then a gentleman in the green T-shirt, please.
One for Aberdeen. How do you replicate the index, and do you use derivatives at all?
In the investment trust. Yeah, we replicate the constituents of the FTSE 350 index, and we hold the majority of the small cap stocks. We currently hold about 585 stocks out of roughly 630 in the index. But we'd look at all holdings versus the index weight, and then we roll that up to sector weight, so that we can see if there's any mismatches between the index and the underlying portfolio. And we'd also roll that up to the underlying indices, the FTSE 100, the 250, and the small cap. And if there's any areas in the small cap index, because it is only the small cap stocks that we don't hold in any amount, then we'll look to rectify that. But to be honest, there's a very large tail of very small stocks within the small cap index. And there's no benefit in us picking all of those stocks up. That just creates cost.
So you are deliberately avoiding the small caps?
The really, the tiny stuff. We tend to look at least a minimum holding of 25,000 in a particular stock, and that will be tiny within the fund.
Does that help?
No, that was quite... Yep, I'll speak to you afterwards.
Yeah, no problem.
Gentleman in the green T-shirt, then gentleman in the blue jacket at the back, please. And then a lady at the front, and that might about see us through.
Yeah, thank you very much. My question is in relating to the products and how retail investors can compare like with like and long-term performance across the board. So ETFs, closed-end, open-ended, passive particularly, and open-ended active. And I think it's based on the likelihood that there's going to be increasing interest in these products with the pension freedoms from next year, people going to use them to draw down or induce, however you define drawdown. The question is this: are there any proposals or mutterings about improving the declaration of long-term performance, because I would particularly like to see total return long-term performance as we see now. We've got that regularly in the literature, but also total payouts in dividends, and therefore capital return without dividends, because clearly a lot of people are going to be looking to draw the income, not as drawdown, but as the income itself. And I think there is a gap there in the literature about what the long-term performance of the relevant products are.
So,
I can just take that for the investment trust. We do actually show both total return and capital return. So that if you go to the Aberdeen website and click through to the investment trust area, and then you'll be able to see those capital returns and the total return figures.
Yeah, on a more general note, I would say that passive investments generally do tend to be very good at declaring information that's relevant to investors. But you're right, sometimes some products it'll be easier to find historic performance information than others. I know that there are moves from a lot of some of the regulators and some of the product groups to do more declarations. What I would say is, if there's information you're struggling to find, give your broker a ring, have a word with them. Often, I know that we ourselves will be able to find information sometimes that's not readily available on individual products, but we just need to know what specific information that you need. But certainly, Hargreaves would be happy to help you if there was something you needed specifically for an investment.
Thank you. And a gentleman there, please. And then the lady in the scarf will be the last question, I suspect.
Yes, I'm interested in the underlying currency risks, particularly with the investment trusts. Things like the Aberdeen New Tie, where the currency is quite volatile. What are the underlying, or if you have emerging markets?
Talk to Hugh Young in
Yeah,
Singapore, might be the
I
answer.
was going to say that, yeah, that's totally away from my area of investment trust. It's only the passive UK trust that I look at. So it will probably be best to speak to an expert at Aberdeen or look at the literature on the website for the investment trust, whichever particular investment trust it is you're interested in.
Obviously, there are people from Aberdeen here, and there's a lady from Aberdeen about 2 rows in front of you who's going to wave at you right there. So Federica may be able to help you. Lady here, please.
Could you please just give the definition of an active and a passive?
Gosh, that's a good one.
Well, I'll start with the passive definition, or my version of a passive definition would be that the fund targets the benchmark return, both in terms of capital and income. Whereas an active fund, they will have a benchmark index, but they will stock pick a portfolio around that, and some of the holdings may not even be part of the benchmark index. That they are looking at companies to outperform, and therefore the overall portfolio would outperform the benchmark. So that's what active fund management is. Stock picking, basically.
Sorry, we've probably done that right at the top. We've probably assumed a little bit too much knowledge there. Sorry about that, but that's a really, really good question. Maybe we can double back on that one at the end. We've got time for one more very quick one, potentially. Gentleman here, please. Sorry, so we'll take that one afterwards. Thank you, please. Last one. Big shout. Yeah.
Asset management.
Oh, it's about Scotland, this one, isn't it? I can feel it coming. What are the implications for the Investment Trust of Scotland's vote on Thursday?
I need to get back up the road to Edinburgh and vote on Thursday for a start. Absolutely. Aberdeen's politically neutral. And at the moment, the vote hasn't even taken place. And post the vote, there are lots of known unknowns: currency, taxation, regulation. So it's really difficult to actually decide.
The question is, what are you going to do? And what's going to be the impact?
Right.
Aberdeen Asset Management are based in Scotland, aren't
They've got offices in Edinburgh and Aberdeen. Well, we're based all over. Yes, yes.
So, we may not be able, at some stage, to actually invest in Scottish companies if you say yes. And that some of the wrappers, some of the VCTs that you used to manage, what you still do, are going to have problems.
Well, let me say, for example, the UK Tracker Trust is actually registered in England. So, but basically, the companies are going to act with the best interest of clients at heart. So, whatever that means, because we don't know any results yet. I'm trying to be as neutral as possible here.
It's an interesting way to end. Madam, thank you for your question about active versus passive. And please, can we give a very big hand to both Adam and David for their help. Well done, guys. Thank you.